That has been terrible advice. You are poor. These guys don't understand how the SPY ETF works. Arrogant and ignorant millennials, morons. Stop spreading this disastrous advice, mate. Welcome back to another video, and I've never been called a mate before, and honestly I don't really know how I feel about it. But those were some of the comments that can be found on my most viewed video, which is S&P 500 Index Fund is a terrible investment. Don't listen to Warren Buffett. Probably because I'm telling people not to listen to the great Warren Buffett, who of course is arguably one of the most successful investors in the world. The same video is also my most disliked video. But let's change the odds to my favor a bit, and there we go. In any case, I was patting myself on the back for passing 500 subscribers and a portfolio going over $30,000, but I think the universe as a whole just wanted to trim down my ego because I received these two negative comments back to back. It's just heart-wrenching. But all this just got me wondering why so many people hated this particular video. So to show all of you that I'm a man of self-reflection, I decided to rewatch the video to see if it still held up. And after rewatching it not once, but twice, I've come to the conclusion that Warren Buffett is still wrong, and we shouldn't listen to him. Okay, so thank you for watching, and I'll catch you in the next video. Bye. I'm just kidding. But here's the video analytics, and what's interesting is that most people only watch 3 minutes and 56 seconds of the video, basically up until this point where I listed 3 points I'll be arguing against. Meaning the average viewer, they never heard my counter arguments, they just disliked the video, left early thinking that I'm just a poor, arrogant, ignorant, moronic millennial, and giving out disastrous advice. So in today's video, I'm going to be responding to some of the comments left on my most viewed, most hated video, and let's see if I can change some of these haters into lovers. I mean supporters, but you know what I mean. Anyway, the Warren Buffett advice I was telling people to ignore in the video was this one. For most people, the best thing to do is to own the S&P 500 Index Fund. And the 3 points I made were that VOO, or VOO, which is Vanguard's S&P 500 Index Fund, is a terrible investment because, number one, it lacks proper diversification and it leans heavily towards tech stocks. And number two, people can create portfolios that provide better diversification and less risk, or more risk but give you better return by simply investing in different sector ETFs. And number three, VOO's low expense ratio of 0.03% compared to Vanguard sector ETF's 0.10%, it shouldn't stop you from creating your own tailored portfolio. I mean, Jesus, that was a mouthful, and I need a drink, but with all that clarification out of the way, let's get through some of the comments. Starting off with the most recent comment, we have Julio, or Julio, rubbing in the fact that I'm poor compared to Warren Buffett. And yes, I currently don't have $84.6 billion, but I'm pretty sure Warren Buffett didn't start off that rich. I'm almost 30 years old, so let's compare and see how much Warren Buffett was worth at that same age. So here it is. By the time Warren Buffett was 30 years old, he had a net worth of $1 million or $9.3 million adjusted for inflation. Alright, never mind. You in this comment, Julio, but thanks for the view anyway, and probable dislikes. Next, we have Mercenary. And while I do agree that there are many moronic millennials who think they know better out there, a lot of millennials have actually invested in tech names like Apple way before Warren Buffett did. While Berkshire Hathaway, they now have several investments in tech stocks like Amazon or Snowflake. That's more thanks to Warren Buffett's lieutenants who pick out stocks that he personally doesn't understand. So, don't discount the millennials because you might be onto something here. Next comment, we have electric cars, asking what index fund I like. And I mentioned this before, but I invest in Vanguard Sectors ETF with a heavier focus on VOX, which is a communication ETF, VCR, the consumer discretionary ETF, and VGT, the information technology ETF. And this next comment kind of confused me because he wrote that no one can beat the market, but then the next sentence he writes that only a few unicorns can. So which one is it? Once again, I'm not saying investing in the S&P 500 index fund is bad, is way better than not investing at all. I'm simply noting that investing in sectors that you believe in the most can help you diversify and manage your risk better. Also, all these three ETFs that I mentioned, VGT, VCR, and VOX, they self-clean as well, and they rotate out companies that don't perform relative to their peers. I mean, that's how most ETFs are structured, so while I agree that we should use capitalism to make us wealthy, overall, this comment was just contradictory and confusing. Alexander, he took the time to write out this long comment, so I definitely appreciate him. And he does make 3 points in his comments, and let's go over them one by one. And the first one I agree with, and I know that there's better ways to calculate returns, but for simplicity's sake and because I don't want to go through all the calculation, I just like to take the stock's 5-year returns and just divide it by 5, just so I can get a quick average annualized return. And second point, I only say that an S&P 500 index fund is flawed because it gives the illusion of equal diversification between all the different sectors, while at the same time being mostly 30% into tech stocks. So if you're a retiree or someone who is more risk adverse, having such a high percentage in tech stocks, which is typically more volatile, it's not going to be a good investment choice. And his final point, again, it sets up the argument that the average investors, they aren't smart enough to build a stock portfolio, so should just leave it up to the professionals. And the issue, honestly, is that not everyone is looking for massive gains or looking to beat the stock market. Sounds counterintuitive, but for example, someone who's aiming to preserve their wealth while getting some dividends, they might not be focused on gains as much as, once again, preserving their wealth. This is why I talk about investing in sector ETFs specifically, because you're able to tailor-make your own portfolio in areas and, sectors that you want to. In the video I mentioned, for example, I said that someone, might not want to invest in big oil or support, Exxon or Chevron. And if that person invests in an S&P 500 index fund, that's not ideal because they have a few percentage in energy stocks. So picking out other sectors and just leaving out VDE, which is Vanguard's energy ETF, that's going to be the way to go for them. And likewise, once again, if you don't want to deal with the volatility of tech sector, you can just invest in the other 10 sectors instead. Because much like picking individual stocks, it gives you the ultimate freedom to chase diversification, crazy returns, or whatever your financial goal is. For the average person who doesn't want to do the grunt work and look at financial statements but still want to, create their own thing, starting out with 11 choices on this list is going to be, a pretty good way to start. I know this was a long response to Alexander, but he did write a very long comment, which I appreciate, of course. And if you ever watch my videos and you disagree with what I'm saying, definitely just leave a comment because I tend to reply to mostly all of them. But moving on, next we have Rep in Time, who says that not one investor can beat index fund returns. And I think Warren Buffett or, Peter Lynch, they might disagree. But yes, for various reasons ranging from emotional control or fear of missing out, many retail investors and even hedge funds, they have a hard time beating the index fund returns. As for the intense investor, you're welcome, my homie. And I hope you still learn from this terrible advice given in my videos. And finally, I agree with Ryan because my whole Don't Listen to Warren Buffett video, I basically said that the SPY or any S&P 500 index fund, it's usually touted as the best investment for the average consumer. But once again, I believe that a sector ETFs, making your own portfolio, is going to give you better diversification, that's going to be more aligned with what you want to invest in and which companies and sectors that you want to support. I think there's a natural evolution of how you do your investment because I started my investing journey with VOO, which is Vanguard's S&P 500 ETF, but I slowly transitioned more towards individual stocks, and now I hold individual stocks and also sector ETFs. And every month I've been documenting the returns that I've seen, and so far I've been beating out the S&P 500 returns, but we'll see in the long run, in a few years, where my returns stand. Hopefully it'll be a bit better than the S&P 500 returns. If not, this video is going to be pretty stupid. But with all that said, I think I'm just going to end the video here because I don't really think there's anything else to say. People who watch the video and they get it, they're going to get it. And people who watch the first 3 minutes and 59 seconds and they don't like what they hear, then they're going to hit the dislike button. Nothing I can do. But in the meantime, if you want to be a part of my investing journey and see the dollar signs on my thumbnail grow and grow, make sure to subscribe to stay up to date. And if you enjoyed this video, hit the like button, but you can always hit the dislike button if you want to. No pressure either way. But with all that said, thank you so much for stopping by. Happy investing. Stay safe out there as always. And I'll see you guys next time with more financial shenanigans.